Hancock Whitney delivered a strong second quarter that, well, effectively beat consensus expectations across the board.
Yeah, a really solid beat.
Right. And if you are tracking the headline figures with us today, the bank posted earnings of $1.55 per diluted share.
Which is a massive jump from Q1. I mean, Q1 was just 57 cents.
Exactly, but you got to remember, Q1 included that nearly $100 million restructuring charge.
Right, right.
Still, it's a huge jump. Top-line net interest income came in at just over $295 million, so that's up 3% from the first quarter.
And non-interest income hit about $108 million?
Yeah. Looking forward, management's full-year 2026 guidance projects low double-digit growth for both loans and deposits.
Assuming the One Florida Bank acquisition actually closes August 1st, of course.
Right, assuming that closes. They also signaled flat to modest margin expansion for the second half of the year, which is huge.
And the market absolutely loved the print.
Oh, totally. The stock had serious momentum heading out of the quarter, closing just under $75, $74.72 to be exact.
Yeah, which is a significant run-up from Q1's close around 63.
And that price action was heavily supported by the bank, repurchasing over 712,000 shares at an average of about $68.
Yeah. So if you think about it, imagine ripping up your own floorboards to fix your house's foundation.
Oh.
You know it's going to cost you like nearly $100 million today, but it might just save the entire structure tomorrow.
Right, it's an investment in survival.
Exactly. That is exactly what Hancock Whitney did last quarter. They took a massive loss to fix the foundation of their balance sheet, and the market rewarded them for basically ripping that Band-Aid off.
And that brings us to the mission for today's deep dive. We are looking at a regional bank that took a deliberate, painful gamble 90 days ago.
A huge gamble.
Right. Today, we need to answer one crucial question for you. Did that gamble actually pay off? And more importantly, what does their Q2 survival playbook mean for the rest of the banking sector?
Because you don't get a stock price jump of that magnitude just on top-line earnings beats.
No, you really don't. You get it because the underlying mechanics of the balance sheet are actually working. So let's just break down the segment performance and the margin mechanics that engineered this beat.
Well, the balance sheet growth here is just highly impressive, especially when you look at the rate of change.
Yeah.
Total loans hit $24.6 billion. That translates to a 10% annualized growth rate compared to the first quarter.
Wait, 10% annualized?
Yeah, 10%.
I mean, we have to pause on that number because in a macroeconomic environment where borrowing costs are still incredibly high, getting businesses to take on new debt is tough.
It's incredibly difficult.
So seeing a 10% annualized loan growth right now is a major standout figure.
And it wasn't just, broad-based luck. The growth was highly targeted. They drove it primarily through commercial and industrial lending, so lending to operating businesses as well as healthcare and commercial real estate.
Okay. And on the funding side, to support all those loans, they grew total deposits to almost $30 billion.
Yeah, $29.6 billion.
Right, which is an 8% annualized growth rate, fueled almost entirely by interest-bearing transaction and savings accounts.
Which is great, but we really need to unpack this deposit mix.
Let's do it.
Because this is where Hancock Whitney is flexing a major competitive advantage, and we need to understand the mechanism behind it.
Yeah, growing deposits by 8% annualized is tough, but what really dictates a bank's profitability is the cost of those deposits.
Exactly. Non-interest-bearing demand deposits, or DDAs, remained virtually flat this quarter, but, and this is key, they still represent a staggering 35% of total deposits.
35%, just to translate that for you. Having over a third of your entire deposit base costing you literally 0% in interest, I mean, that is an incredible financial shock absorber.
It is the absolute definition of a high-quality funding base.
Yeah.
And you have to ask how they maintain that. I mean, when you can get 4 or 5% in a basic money market fund, who leaves billions of dollars sitting in a checking account yielding 0?
Right. It doesn't make sense on paper.
But the answer connects directly back to that commercial and industrial loan growth we just talked about.
Oh, because of the operating accounts.
Exactly. When Hancock Whitney makes a loan to a mid-sized healthcare company or like a manufacturing firm, they aren't just making a loan. They mandate that the business brings over its treasury operations.
Ah, right. So that means the business's payroll accounts, their operating accounts, the money they need liquid every single day that all sits at Hancock Whitney.
Oh, yep. That money doesn't chase high yields. It just stays put.
That makes total sense.
Yeah.
They are capturing the operating plumbing of these businesses.
Yeah.
And that 35% zero interest ratio is exactly why their net interest margin, their IM, performed the way it did.
Yeah, the margin was a big highlight.
Now, think of net interest margin like tuning a high-performance engine. The loans they write are the fuel coming in, generating revenue. The interest they pay out on deposits is the exhaust going out.
Right, and the wider the gap between the two, the more horsepower the bank generates.
Exactly. This quarter, their NIM ticked up 1 basis point to 3.56%.
Which, on the surface, 1 basis point sounds like a rounding error.
A total rounding error, yeah.
Yeah.
But it's the internal tuning of that engine that is so fascinating.
Precisely. If you break down the components of that margin, you see a masterclass in balance sheet mechanics.
Let's hear it.
The margin benefited from a higher investment portfolio yield, which added 2 basis points.
Okay.
And a lower overall cost of deposits, which added 3 basis points.
Right.
Those internal efficiency gains successfully offset 2 external headwinds. Unfavorable borrowing costs, which dragged the margin down by 3 basis points, and slightly lower loan yields, which took off 1 basis point.
So they have top-line loan yields facing headwinds, losing a basis point there.
Yeah.
And their wholesale borrowing costs are unfavorable.
Yep.
But they are squeezing so much efficiency out of their deposit costs, saving those 3 basis points and getting better yields from their investment portfolio, that they still manage to generate forward momentum.
Exactly. They found torque in the internal mechanics of the balance sheet, even when the external macro environment was basically causing drag.
And that higher investment yield is the direct mechanical payoff of taking the early pain back in Q1, right?
Yes, absolutely. When we talk about that nearly $100 million restructuring charge, what actually happened?
Right. What was it for?
Well, they looked at their portfolio of bonds and securities that they bought years ago when rates were near zero. Those bonds were acting as dead weight, just dragging down their interest income.
Because they weren't yielding anything.
Exactly. So they sold them at a massive loss to clear them out and reinvested that cash into new securities at today's much higher interest rates.
And now, in Q2, we see the investment portfolio yield is up 12 basis points to 3.35%.
Yeah, they took the hit to overhaul the engine. And now that higher yield is actively defending the margin against pressures on the loan side.
But here's the catch with building a highly efficient organic engine. Once management proves they can run their current balance sheet smoothly, they inevitably start looking for ways to scale it up.
Oh, always.
The success they're seeing in organic loan growth naturally sets the stage for an aggressive inorganic growth strategy, which forces us to look at their impending acquisition and, whether they can scale without breaking the machine.
You could really hear the validation of this dual growth strategy in the management commentary.
Yeah, CEO John Hairston's tone was highly confident.
Very confident. He explicitly cited, quote, exceptional progress on our organic growth plan. But to your point about external expansion, they aren't just acquiring another institution. They are aggressively recruiting human capital.
Right. They hired 15 net new bankers in Q2 alone.
Yeah, that brings their total to 42 net new bankers in just the first half of the year.
So they are paying up for premium talent to drive organic loan origination while simultaneously opening the checkbook for mergers and acquisitions.
A dual-pronged attack.
Let's get into the One Florida Bank acquisition, which they refer to as OFB.
Yeah, the OFB deal is expected to close imminently on August 1st.
Let's look at the actual deal metrics for you guys. It is an all-cash consideration of roughly $377 million.
Right, $377.6 million. And in return for that cash, Hancock Whitney brings in $1.7 billion in new loans and $1.8 billion in deposits.
Wow. And from a geographic standpoint, this gives them crucial density in high-growth Florida markets, like Orlando, Jacksonville, and the Panhandle.
Yeah, it's a great footprint. Financially, management expects this to be EPS accretive in the high single digits.
Just to clarify that, for you, EPS accretive simply means that even after paying $377 million to buy the bank, the earnings generated by One Florida Bank will be high enough that Hancock Whitney's overall earnings per share will actually increase.
It adds to the bottom line rather than diluting it.
Exactly. But what about the payback period?
So they are modeling a tangible book value earn back of about 4 years.
Okay, so essentially it'll take them 4 years to recoup the premium they paid over the raw net worth of One Florida Bank.
Right. But the critical piece of this modeling, and where a massive chunk of that EPS accretion actually comes from, is the cost synergy assumptions.
Oh.
Hancock Whitney is projecting a 40% cost savings on OFB.
Wait, stop there. A 40% cost savings.
Yeah, 40%. That translates to almost $16 million in reduced expenses, fully phased in by 2027.
Stripping out nearly half of an acquired bank's entire operating cost base by 2027 sound incredibly aggressive.
It is. To achieve that, they are also modeling $30 million in one-time merger expenses to cover things like severance packages and, breaking old vendor contracts.
This is a tension you absolutely have to consider if you're holding this stock. It requires ruthless efficiency.
Oh, yeah. Consolidating back offices, firing redundant management, shutting down overlapping branches, integrating IT systems.
Exactly. Yet, at the exact same time, they're investing heavily in organic growth, hiring 42 net new bankers in 6 months.
Right.
How smoothly can a regional bank balance ruthless M&A cost-cutting in the back office with this massive aggressive expansion in the front office? I mean, are they risking severe cultural whiplash here?
That is the pivotal question, and it perfectly highlights the execution risk inherent in the specific growth model.
Yeah.
You are asking a single organization to act as an axe in the back office and a magnet in the front office. When you acquire a bank and immediately target 40% cost saves, you risk destabilizing the very deposit base you just paid $377 million to acquire.
Right, because if back office cuts lead to poor client service, or, if customers get frustrated by glitchy IT integrations,
They leave.
yeah, those $1.8 billion in deposits won't stick around. They will just walk out the door to a local competitor.
Exactly. However, hiring those 42 net new bankers is essentially their insurance policy.
Flood the zone.
Yeah, they're flooding the zone with high-performing revenue producers. The strategy is to generate so much new organic business that they can simply outgrow any customer attrition caused by the back-office integration.
It is a high-wire act.
There is zero room for operational error. But if they pull it off, the operating leverage, basically the ability to generate more revenue without increasing fixed costs, is massive.
It is a high-wire act indeed. An aggressive expansion, whether you are doing it organically by bringing in new lending teams or inorganically via a $377 million acquisition, it always brings structural risk.
Always.
When you bring on $1.7 billion in new loans from an acquisition, you aren't just buying revenue, you are buying risk.
Yeah, it expands the balance sheet, but it also expands your exposure.
Which naturally forces us to ask, how durable is this loan portfolio if the economy stalls? Let's analyze how well Hancock Whitney is protected against potential defaults and macroeconomic shocks.
Well, if we look strictly at the asset quality metrics reported for the second quarter, the balance sheet appears incredibly resilient.
Okay, let's look at criticized commercial loans.
Right. These are loans that the bank's internal risk managers have flagged as showing early signs of potential weakness. Those criticized loans actually decreased.
Nice.
Yeah, they dropped by $30 million down to $492 million, which represents just 2.5% of total commercial loans.
That's pretty low. Furthermore, non-accrual loans, which are loans that have completely stopped paying interest, are virtually flat at a very healthy 0.46% of total loans.
And management explicitly noted on the call that they are not seeing broad signs of weakness in any specific industry, collateral type, or geography.
So the loans they already have on the books are performing well, and early warning indicators are actually shrinking.
Exactly.
What about the actual realized losses?
Net charge-offs. So the loans the bank actually had to write off as uncollectible were incredibly low.
How low?
They came in at 0.16% of average total loans on an annualized basis.
Wow, 0.16. That is actually down from 0.19% in the first quarter.
Yeah. And because their charge-offs are so microscopic right now, their reserve levels remain exceptionally strong.
Right, the allowance for credit losses, known as the ACL, it's essentially the rainy day fund they set aside to cover future bad loans.
Yep. And that coverage ratio remains solid at 1.42% of total loans. To maintain that, they took a $13.8 million provision expense for the quarter.
So that provision easily covered the $9.4 million in net charge-offs they experienced, and it still allowed for a $4.4 million net addition to the reserve build. And from a structural defense standpoint, they are sitting on a tangible common equity ratio of 9.78%.
More importantly, they have a CET1 ratio estimated at 13.18%. 8%.
Yeah, think of CET1, or Common Equity Tier 1, as the bank's ultimate financial armor.
Right. Regulators want to see banks hold enough pure, high-quality capital, like common stock and retained earnings, to survive a crisis without going under.
It is the money that can't disappear in a bank run.
Yeah.
So sitting above 13% means they are heavily armored and easily have the capital to absorb a shock.
Yep.
But I want to dig into that $13.8 million provision they took, because the mechanism behind how they calculated that specific number is highly revealing.
It absolutely is, because the provisioning model tells you what management is really worried about behind closed doors.
Yes, exactly.
In Q2, management shifted the weighting of their macroeconomic scenarios, which are provided by Moody's.
Right, because by law, banks have to model their future loan losses based on different economic forecasts.
Exactly. In the first quarter, Hancock Whitney weighted their model 40% to the baseline, normal economic scenario, and 60% to a slower growth downside scenario, known internally as S2.
Okay, 40 normal, 60 slower growth.
Right. But for Q2, they shifted that weighting. They moved it to an even 50% baseline and 50% slower growth.
Let me stop you there.
Yeah.
If they shifted from a 60% downside weighting to a 50% downside weighting, doesn't that inherently imply a more optimistic outlook on the economy?
Well, mechanically, yes, it is slightly less pessimistic than Q1, but a 50% downside weighting is still heavily defensive.
True.
What is truly fascinating here is the specific justification management provided for maintaining a full 50% weighting on a slower growth scenario.
What was it?
They explicitly stated in the filings that this forecast reflects the potential downside impacts of international conflict.
International conflict.
Yeah. We are talking about supply chain shocks, potential inflation rebounds driven by energy markets.
For a regional bank focused primarily on the Gulf south of the United States, to explicitly cite global international conflict as a driver for their local credit reserving model.
Yeah.
I mean, that shows a high degree of macroeconomic paranoia.
It really does.
Okay, I have to challenge the optics of this risk shift, because to you and me, looking at the entire board, there is a glaring contradiction in the narrative they are presenting.
How so?
Well, on paper, criticized loans are down, non-accruals are flat, and net charge-offs are actually dropping. They look utterly bulletproof.
Right.
Their CEO gets on the earnings call, sounds highly confident, and proves it by hiring bankers by the dozen and buying a bank for cash.
Yeah.
But then, deep in the accounting department's provisioning model, by locking in a 50% slower growth scenario tied to international conflict, they are quietly bracing for extreme turbulence.
Yeah, I see what you mean.
Are they talking out of both sides of their mouths to investors, projecting absolute aggressive confidence on the earnings call while modeling for a severe recession in the back office?
It is a totally fair critique. It does look contradictory on the surface, but I would argue that this duality is actually the hallmark of sophisticated elite bank management.
Okay, defend that for me.
You have to actively separate the business generation strategy from the risk management strategy. The front office, the CEO, the 42 new bankers, they have to be wildly optimistic.
Sure, they're salesmen.
Exactly. They have to believe they can steal market share and originate great loans in any economic environment. But the back office, the chief risk officer, the provisioning models, they are paid to be paranoid.
Right.
If they weren't bracing for turbulence with a 50% downside weighting, especially given the current geopolitical climate and rate volatility, bank regulators and institutional investors would actually be deeply concerned.
That's a point.
The fact that Hancock Whitney can maintain a heavy 1.42% reserve coverage ratio, model for international conflict, and still post incredibly strong returns on their equity shows they're successfully pricing all that risk into the interest rates they charge on their loans.
So what does this all mean for you as someone analyzing Hancock Whitney right now?
Well, you have a regional bank that took a deliberate, painful hit in the first quarter to fix the foundation of its balance sheet.
Right. They swallowed a nearly $100 million net loss just to restructure their securities portfolio, basically clearing out the dead weight.
And now, 90 days later in Q2, we are seeing the direct mechanical payoff of that decision.
We're seeing higher investment yields actively driving net interest margin expansion at a time when almost every other regional bank in the country is struggling with severe margin compression.
Exactly. They recognized the reality of the higher for longer rate environment early. They took their medicine when others hesitated,
Yeah.
and because they did, they are now operating from a position of immense structural strength.
Which is exactly what allows them to confidently execute a $377 million all-cash acquisition, target aggressive back-office cost cuts, and simultaneously hire top-tier lending talent to flood the zone in their new markets.
It's all connected.
Which leaves us with a forward-looking strategic takeaway to mull over as we look at the broader financial landscape. Hancock Whitney proved that taking a massive, ugly quarter to restructure your investment portfolio absolutely works, but only if you have the underlying deposit stability, like that 35% zero-interest base, to weather the storm.
Couldn't agree more.
The thought to ponder as you look across the rest of the financial sector: will taking the early pain of portfolio restructuring become the mandatory survival playbook for regional banks trying to navigate a higher-for-longer rate environment? Follow the show for daily earnings coverage.